What if I told you that there's a secret weapon buried deep within your charts, one that most traders overlook? And what if I said that by mastering this one powerful signal, you could spend just 10 minutes a day trading and make 10 times more than those glued to their screens all day? Sounds too good to be true, right? But this strategy is so effective, it's like having a crystal ball for spotting reversals and key market moves. In this video, I'm going to reveal exactly how you can use this game-changing pattern to level up your trading and achieve consistent profits. Ready to find out what this secret is? Stay tuned. Imagine spotting a subtle clue on your trading chart that could signal an impending market reversal. That's exactly what a pin bar does. A pin bar is a unique candlestick pattern, easily recognizable by its small body and long wick, showing rejection of a specific price level. That long wick? It's the market's way of showing that price tried to move in one direction but got quickly pushed back, hinting that the market might reverse. So, why should you care about pin bars in your trading? Pin bars are powerful because they can help you catch market reversals before they happen. Whether you're trading forex, stocks, or commodities, this pattern can give you an edge by highlighting potential turning points in the market. Plus, pin bars are incredibly versatile. They show up across different time frames and markets, giving you plenty of opportunities to use them in your strategies. So, what's the catch? While pin bars can offer high probability setups, they're not foolproof. Sometimes the market might fake you out, continuing in the same direction even after a pin bar forms. That's why it's important to combine them with other tools, like support and resistance levels or trend lines, to improve your accuracy. And that's what I'll show you, so don't skip any part and watch carefully, because this candlestick pattern, which you might overlook, can dramatically improve your trading account. Let's dive into what makes a pin bar so powerful in your trading. A pin bar is made up of three simple but key parts: a small body, a long wick or tail, and a short shadow. The small body represents the open and close prices during a specific time frame, showing minimal movement. But here's where it gets interesting: the long wick is where the action is. This wick tells you that the market tried to push prices in one direction but got smacked back, indicating rejection of that level. The short shadow on the opposite side just reinforces this, showing that the market couldn't move much in that direction. Now, when you see a bullish pin bar, it's often at the end of a downtrend. The long lower wick shows the market rejected lower prices, suggesting that buyers are stepping in, and a reversal could be on the horizon. On the flip side, a bearish pin bar shows up after an uptrend with a long upper wick. This means higher prices were rejected, and sellers might be about to take control. So why does the tail matter? The longer the tail, the stronger the rejection of that price level. A long tail means the market tested those levels and failed a clear signal that a reversal could be coming. This is what makes pin bars such powerful signals in identifying trend shifts and making your next trading move. So how do you spot a bullish pin bar? It's simple. Look for a pin bar with a long lower wick. This means the market tested lower prices but quickly rejected them, signaling that buyers are stepping in and pushing the price back up. You'll often see these bullish pin bars at the end of a downtrend, hinting at a potential reversal to the upside. When you see that long tail below the small body, it's like the market is telling you, nope, we're not going lower. Time to consider a long position. On the other hand, a bearish pin bar has a long upper wick, signaling rejection of higher prices. Sellers are taking control after the market tested those higher levels but failed to hold them. You'll usually find bearish pin bars at the end of an uptrend, indicating a possible downward reversal. It's like the market is saying, that's as high as we're going for now. Pin bars don't behave the same in every market condition, so understanding how they act in trending versus ranging markets is key to using them effectively. In a trending market, pin bars can be your best friend. In an uptrend, a bullish pin bar with a long lower wick often signals that the market rejected lower prices and is about to resume the upward movement. This can give you a great entry point to ride the trend. Let's start with the basics of an uptrend. An uptrend occurs when the market continuously forms higher highs and higher lows, signaling that buyers are in control. The price moves in two phases: impulsive waves, which are strong upward movements, followed by retracement moves, which are temporary pullbacks. These retracements are a natural part of the trend and give the market a chance to breathe before resuming the next upward push. Now, where does the bullish pin bar come into play? During an uptrend, a bullish pin bar often forms at the end of a retracement phase. The key feature of this pin bar is its long lower wick, which indicates that the market tried to push lower, but buyers quickly stepped in, rejecting those lower prices. This shows that the retracement is likely over, and a new impulsive move in the direction of the uptrend is about to begin. This creates an excellent opportunity for you to enter the trade with lower risk and higher reward. By placing your entry at the close of the pin bar, you're setting yourself up to catch the next impulsive wave as it starts, while keeping your stop loss just below the pin bar's tail to minimize risk. Essentially, the bullish pin bar gives you a reliable signal that the uptrend is about to continue, allowing you to take advantage of the market's momentum. By using pin bars to time your entries during an uptrend, you're not only trading in line with the dominant trend, but also improving your chances of finding high probability setups, which is a key principle in successful trading. In a downtrend, the market consistently forms lower highs and lower lows, indicating that sellers are in control. Price moves in impulsive waves followed by retracement moves. These retracements are short-lived as the sellers prepare to push the price lower again. A bearish pin bar typically forms at the end of a retracement during a downtrend. The long upper wick of the pin bar shows that the market tried to push higher, but sellers stepped in and rejected those higher prices, signaling that the retracement is over. This indicates that the market is likely to resume its downward impulsive move. This gives you a great opportunity to enter a trade with lower risk and higher reward. By placing your entry at the close of the pin bar, you're positioning yourself at the start of the next downward push, allowing you to ride the new impulsive wave. With a stop loss just above the pin bar's tail, you can minimize risk while maximizing profit potential. Essentially, the bearish pin bar provides a reliable signal that the downtrend is about to continue, allowing you to take advantage of the selling momentum and improve your chances of catching the dominant trend's next move. In ranging markets, the price moves sideways within a defined range, oscillating between support and resistance. In these conditions, pin bars tend to form at these key levels, offering potential trading signals. When a bullish pin bar forms near support, it suggests that the market tried to push lower but was rejected by buyers stepping in at that support level. This rejection can indicate that the price might bounce back toward resistance, presenting a good opportunity to go long. On the other hand, when a bearish pin bar forms near resistance, it signals that the market attempted to break higher but got rejected, indicating potential downward movement back toward support, a good opportunity to go short. However, trading pin bars in ranging markets comes with caution. Since the market isn't in a strong trend, false signals are more common. For example, a pin bar might form, but the price could still break through support or resistance, especially in consolidating or choppy markets where there's no clear direction. That's why it's crucial to combine pin bars with other technical tools, like volume analysis, oscillators like RSI, or price action patterns, to confirm the strength of the signal. When it comes to trading pin bars, choosing the right time frame is crucial for accuracy and reliability. The daily and 4-hour charts are generally considered the best for spotting pin bars. These higher time frames help reduce market noise, giving you clearer and more reliable signals. Pin bars on the daily chart can indicate strong potential reversals, as they reflect a full day's worth of market activity, which carries more weight than a single hour or minute. The 4-hour chart is also highly reliable, offering a balance between capturing medium-term trends and providing enough detail for more frequent setups. It's a great option if you want more trading opportunities without sacrificing too much signal quality. On the 1-hour chart, pin bars can still provide good setups, but they come with more risk. Lower time frames tend to have more market noise, meaning short-term fluctuations can lead to false signals. Price action on lower time frames is more reactive and can mislead you into thinking a pin bar is signaling a reversal when it's just a minor fluctuation in a broader trend. For this reason, it's generally better to avoid pin bars on time frames lower than the 1-hour chart, as these tend to be less reliable and require extra confirmation with other indicators. Focusing on the daily, 4-hour, and 1-hour time frames will improve your chances of success by providing more accurate and meaningful pin bar setups. Now that you've learned what a pin bar is and how it works, here's the real key. Trading pin bars on their own isn't enough. Think of the pin bar as a signal, but this signal needs to appear in the right places to be effective. That's why combining pin bars with support and resistance levels can give you a serious edge in the market. These are psychological zones that the entire market, including major institutions and banks, watches closely. When price reaches these levels, something significant is likely to happen, and that's where pin bars can provide excellent trading opportunities. Support and resistance levels are crucial because they act as psychological barriers. Support is like a floor for the price when it reaches this level. Buyers often step in and prevent the price from dropping further. Resistance, on the other hand, is like a ceiling where sellers push back, preventing the price from climbing higher. These zones are where the market tends to react strongly, and pin bars that form at these levels often indicate a reversal or significant price movement. Let's say the market is in a downtrend, forming lower highs and lower lows. As price approaches a major support level, it starts slowing down. Suddenly a bullish pin bar forms, the price tries to push lower, but buyers come in strong, rejecting those lower prices and leaving a long lower wick. This is your signal that the downtrend could be losing steam, and a trend reversal may be just around the corner. By placing your entry at the close of the pin bar, you're positioning yourself to catch the beginning of the reversal. You place your stop loss just below the tail of the pin bar, managing your risk in case the market turns against you. With the price potentially moving upward from support, the risk-reward ratio is highly favorable, giving you a chance to profit while keeping your losses controlled. Now imagine the market is in a strong uptrend, making higher highs and higher lows. As the price nears a major resistance level, a bearish pin bar appears with a long upper wick. This wick tells you that buyers tried to push the price higher, but sellers quickly stepped in and rejected those higher prices. This is a sign that the uptrend may be running out of steam, and a reversal could be on the horizon. You can take